Hello and welcome to our launch webinar for Pastoral Profit, the foundations for creating an economically sustainable livestock business in the pastoral zone. I'm your facilitator today. My name's Penny Keynes and I'm also the Pastoral Profit National Coordinator. If you want to get in touch with me, you can see my details there. I'd just like to run through a little bit of housekeeping for you just to begin. So firstly, you've got the red button with an arrow that opens and closes your control panel. This will help you throughout your webinar to open and close it so you can see your screen, or if you need to open it again to ask a question. Now we've got little hands that you can see, and I'd just like to ask you all to raise your hands so I can see whether you can hear me today. So if you wouldn't mind all pressing on that little button to raise your hand. Got a few people raising their hands. Great. Fantastic. It's nice to see you all online. So I'll just put your hands down so you can hear me. That's good. Fantastic. And also, today we'd like you to participate through the questions panel. So you can see this box here where you can type in any questions that you might have for myself or Phil. And throughout the presentation, we'll be breaking for some to be able to answer some of those questions for you. Lastly, I'll just say, if you need to get in touch with us, I've got some support people here at Rural Directions in our office. So if you just call 0888 414 500, someone might be able to give you a hand. So, Pastoral Profit. Pastoral Profit is a new joint initiative between Australian Wool Innovation and Meat and Livestock Australia, and it's targeting the bottom line business management skills to improve the bottom line of pastoral businesses. And by pastoral businesses, we're looking at the grazing industry in pastoral beef, sheep meat and wool producers. When I talk about the pastoral zone, I'm really talking about more of the southern area that's the lower rainfall area of Australia where it's predominantly grassland and grazing enterprises. And what Pastoral Profit is aiming to do is really focus on the business management skills that producers can pick up and use in the future to improve their business's bottom lines and make more informed decisions. So I guess what kind of activities we'll be running? We'll be running more webinars similar to this one, some face-to-face activities, and even some webinars that might be a little bit more interactive with a smaller group and a smaller group of people focusing on a real skill that is around that business management. So we're looking at finding out what producers need and looking at the what it is that will really help your business along. So there's a bit of producer consultation that we want to undertake, and we want you to come to us to let us know what it is that you might want. So for instance, if you're interested in cost of production and finding out your cost of production, that might be something that you go to one of our regional coordinators for, and that will help guide some of their activities and the activities you want to see. So it's relevant and it meets your needs. And as I was saying, there's regional coordinators in each of the states that we've hired, and they're there to be your go-to people. These are the people that we want you to get in touch with if you have a need. Say you want to do some benchmarking in a group, these people will help you and be able to put some of the coordination behind those things. So we've got Queensland, we've got Heather Smith. New South Wales, we've got Mark Gardner. South Australia, we've got Anne Collins, and Western Australia, we've got John Duff. So they're in the middle of creating some of these activities and looking at what sort of things you want. So please, if you have a group or you're an individual that would like to be involved, please get in touch with them. Or if you haven't been able to write down their details today, I'd be really keen for you to go to the www.pastoralprofit.com.au website. That's where you'll find their details, but you'll also find out about what sort of things they're up to and what's happening in Pastoral Profit. So that leads me now to the introduction of Phil. So Phil is here today to talk about the foundations for creating an economically sustainable livestock business in the pastoral zone, something that I'm sure you're all really keen to find out about. So Phil's the principal consultant for Holmes Co, Sydney and Wagga Wagga based firm that's providing advice to corporate and family-owned farming businesses in all states of Australia. So his special interests are commercial beef and wool production, agricultural sustainability, finance and equity investing. We'll have producer Andrew Miller online later, and he'll be able to give us a bit more of a producer perspective of improving the business management side of things and the learning journey that he went on to improve and achieve success in his business. So I'll just get Phil up. Hi Phil, how are you?
Penny, I'm well, thank you.
Good. I'm glad to hear that. We're having a bit of an overcast day here in Clare. Whereabouts are you?
I'm reluctant to admit it, but I'm in Sydney. You know, people say, how the hell can you be involved in pastoral Australia when you live in Sydney? But there it is. I live in Sydney.
No worries. So I might just hand you the controls, and I'll give you the reins.
Thank you, Penny. Okay, are we right to go, Penny?
Right to go, Phil.
Okay. Well, good afternoon, folks. Thank you for joining this. I'm not sure that I have met any of you, and I don't know whether you've come across me anywhere, but I've been concerned that in this presentation, because it's pretty much all business, I'm going to come across like a hard-nosed, bloodless accountant or economist. And I just need to set the scene a bit. I graduated as a vet and for many years got my boots dirty on farms, not only as a vet, but then I moved into more management consulting work, and so I started my career from the ground up in the paddock with sheep and cattle and pastures and crops and stuff. And so I'm not sort of looking down on top of your businesses. I'm looking at them from the ground up. So I thought I'd just mention that today so that you don't think I'm divorced from what really happens out there in the paddock. The reason for that, as stated, is that today is going to be a big picture, high level look at businesses and what they need to do. And it's intimately linked to what goes on in the paddock with the enterprises, the flocks and herds. But unfortunately today we won't have time to get to that level of detail. So we'll see how we go. The starting point with all of this is to develop some level of financial literacy. It's all very well to be literate with words and so on, and literate mathematically, but financial literacy is another branch all on its own. And it's vitally important because there's a language and a set of skills and a mindset and a way of looking at how to run a business that's unique to business activity. And you've got to get on top of that to run the business properly. And there's the first point. if you talk to pastoralists across Australia, as I have, most of them have their focus in the paddock. You know, typically there's a family, and dad may be out there doing all the paddock stuff all day. Mum may be in the office doing the books. Not always the case, but that's often the case. And dad doesn't like coming into the office because mum keeps asking the hard questions about when's that sale going to happen and so on, and telling him that the expenses have gone up. So dad gets a bit gun shy about going into the office. Mum gets a bit frustrated, and you know, the whole scene doesn't work terribly well. Whereas in fact it should be a team approach. So mum has to understand a little bit more about the paddock issues, and dad has to understand mum's problems dealing with the numbers back there in the office. And so it's a give and take thing, and it involves communication to work really well. And when you get it working well, it's a terrific team if that can happen. I don't have any answers to how that team should work well. I'm just making the observation that when it does work well and there's good communication, dad doesn't see the office as the enemy, mum doesn't see the new prime mover as dad's new toy necessarily, then it works a treat. So to begin that process of mum and dad working together, or, you know, two brothers working together, or father and son working together, whatever the team is, to get that process underway, financial literacy is the starting point. And sorry, Penny, there's a bit of a delay here with my clicks on the mouse. Can you drive this for me if I just say next slide? Okay, so we've covered that. So next bullet point, please, Penny. So I have to say that at the start, when people lack financial literacy, invariably they come out of a meeting with the accountant often more confused than illuminated, and it's because they don't understand the language of money and necessarily what the accountant is talking about. And the accountant will almost always be talking about three financial statements: the profit and loss statement, the cash flow statement, and the balance sheet. They are the three pillars of the language of money, and they all interact, and they all tell you something a little bit different about the business. And understanding those and how they interact and what they're telling you is critical. So typically I work with individual clients of my business from 40 years ago until today has been working with individuals. I don't rely on any government assistance or any other form of non-one-to-one revenue. And so when I start working with people, this is a mystery. You know, these three financial statements, what the hell do they mean, and how do I make head or tail of them? But slowly, over time, it becomes clear. It's like learning, if you are fluent in English, it's like learning another language. And it becomes clear, and they get to the point where they can pick up three financial statements of any business. It doesn't matter whether it's a publicly listed company or a farm, and tell you pretty much straight away what's going on and whether it's a good business or not. Now, at the moment, that may sound like being light years away, but believe me, if you put your mind to this, it can happen. So that's the starting point, understanding the language of money and how the three statements tell you everything that you need to know. Next point, please, Penny. This is critical. Your accountant prepares for you each year a financial report for your business. And that's called compliance accounting, and that's done because it's mandated by the government. You have to do it because tax returns involved. And the accountant's job is to prepare your financial affairs in such a way as to be able to determine how much tax you have to pay or how much tax refund you'll get. So that's his job, and that's what most of them do. That report that he gives you, your tax return, is absolutely useless in terms of making management decisions and business decisions about you going forward with your business. It's prepared in a way to often minimise tax, which is quite legal, but in doing so, a lot of artificial assumptions are built in. The depreciation rate on plant and equipment, for instance, is not real. The livestock valuations are not real. The valuation placed on land and infrastructure, it's not real. And so you need a second set of accounts, and that's so easy to do. If you're sitting there doing your quarterly BAS, you are probably using a piece of software that allows you to do that. And with just a little bit of extra effort, you can ask that software to produce a separate set of accounts that report everything in real terms. That is, your plant and equipment is not there at written down tax values, it's there at clearing sale values. Your livestock are there at current market values, not the tax accounting values, and so on. And if you are in the business of reporting quarterly with BAS, it's very easy to set the system up to comply with the law and, report your BAS position. But it's also equally easy to set it up to report how the business is really travelling, what's really going on, and whether it's making any money or not. So there's a distinction there, and it raises another issue on your accountant. If you go into your accountant every year and you come out more confused than when you went in, there's a problem. And if you go in there and the 90% of the discussion is about tax minimisation and how to handle tax refunds, there's also a problem. The accountant should be there as a wealth creator. He should be there advising you on how to run your business to create wealth. And tax minimisation is a minor part of that, but his overall job is a bigger job than that. Unfortunately, not enough producers understand that issue, and too few accountants are prepared to step outside the tax compliance stuff because it's easy that, it has to be done by law, and so they occupy all their time doing that. So there's another big discussion there that we haven't got time for today on what makes a good accountant, how much should they charge you, and are they going to increase your wealth over time or not? Next point, please, Penny. When you've got your management accounts set up properly, so you do your compliance work, that's every quarter, the BAS stuff goes off, but there you go with this set of management accounts, and it's the only way that you can measure business performance. And that is the starting point in this discussion, really. You've got to get financial literacy under control. You have to understand the language of money and so on. You have to spend the time to set up your accounts so that they can tell you how the business is performing. And when you are at that point and you start to measure the performance of your business, you are in a position to ask the question, is this business financially sustainable or not? So it's a big question. It's a question for you in your generation, but if we get time to go into this properly, it's a question for the next generation. Business succession is a huge issue out there in rural Australia, not just in the pastoral zone, but everywhere. And if it's a family-owned place, the chances are reasonably high that business succession will be an issue. And the first question that you need to ask of that is, what am I handing my kids? Am I handing them an asset that's sustainable in the long term, or am I handing them a sentence? Unfortunately, more often than not, the kids are being handed a sentence, and the sooner you find that out and understand that, the sooner you'll be in a position to avoid all the stress and tears and family hassles that come with that later on. So measuring business performance is important in the long term, but it's also important in helping you decide on, what am I going to do if this business is not performing well? Next, please, Penny. This is another big issue. And as I'm talking, think about this as it applies to you. You're sitting down at the end of the year, it's perhaps May or June. You've got a pretty good idea on how much money may or may not be there as a surplus, and you're in the process of putting together next year's budget. Absolutely essential, budgeting for next year. But let's say you've got a $200,000 surplus. What are you going to do with that? There's a whole lot of calls on that. You know, a station or a farm, or I don't care if it's a dairy farm in Victoria or a station at Kalgoorlie, I don't care. They're like cookie monsters. You throw cookies at them, they'll gobble them up as fast as you can throw them. And there's no end to the demands that these things make on your surplus capital. So you're sitting there and you've got this $200,000 surplus. What are you going to do with it? Do we pay down debt? Do we go up and open up a new water somewhere out the back there? Do we buy a new grader? What do we do? In my experience, those decisions, which are really important, are often made on the basis of gut feeling and whim, whereas there should be a hard-nosed, rational approach to that. And there are spreadsheet-based tools that will help you do that. And so often, capital and its allocation is done poorly, and it does not increase wealth over time. In fact, more often than not, it destroys wealth. So as we sit here today talking, you know, the single biggest thing that you can do if you've got debt is to repay debt, because at the moment there's not much else that you can do on a place just at the moment that can create wealth better than paying down debt, especially if there's a lot of debt. But that changes. That's not always the case. You know, in 2 years' time, that recommendation might be entirely different. It might be, let's increase production, and we'll go out there and leave the debt where it is and do some more on increasing production. Next, please, Penny. Unfortunately, today we're not going to go into this very far. Time constraints will prevent that. But at the moment, in the rangelands, particularly the northern rangelands, but I suspect it's the same in the south, there is an overwhelming burden of debt across the pastoral industry. And that should not be the case. And when that happens, it says that the producers who are responsible for that burden don't understand debt management. There's a a lot to this area, and I'll touch on two things. Firstly, what is a safe level of equity? We'll get to that in another slide in a minute. What is a safe level of equity? And I'll answer that a little later on. This is for the long term. You know, there are many, many stations right across pastoral Australia, north and south, that can't afford to have any debt at all, because if they do, the interest on that debt will consume all the working capital. So what is a safe level of equity will come from measuring your business performance. Can this business sustain any debt at all? If it can, how much debt can it sustain? If it takes on more than that sustainable amount, the interest will take up all the spare cash, and there'll be nothing left over for all the other stuff that's important in the short and long term. The second element of it is, what is the true cost of debt? Well, folks, it's not the interest rate. You know, people get hung up on interest rates. The true cost of debt is how long the debt hangs around for. When you sit down and do the sums, if you've got a 10, 20 or 30-year loan and you add up the total interest on those terms that you're paying out, that's where the real cost of debt comes in, not so much the interest rate. So if you walk into the bank and you sit down and negotiate a loan and you haggle and carry on and you get 0.25% shaved off and come out thinking you've done a good job, that's fine. But if you've agreed to a 20 or 30-year term, with respect, you've lost the plot. So, you know, that raises interest-only loans, which I think are a cancer on the industry. They may help some people initially, but the cost of those loans is absolutely prohibitive. So there's a hell of a lot to talk about with debt management, and unfortunately, today we can't go much further than what I've just said. Next, please, Penny.
Thanks, Phil. I'll just quickly invite everyone to continue to keep bringing those questions in as we're going and as Phil's speaking. We've got a couple of more slides to go until we'll answer those, but just don't forget to continue to keep those coming in. I'll change it to the next slide now. There you go.
So when you become, well, I'm sorry, I don't want to be offensive. Many of you may already be financially literate, but for those of you who may have doubts in this area, when you do become financially literate, you will be able to look at data like the one presented in this slide and ask some hard questions. If I take these data out to anywhere in Australia, I don't care whether I'm talking to banana growers, dairy farmers, wheat producers, wool producers, whatever, and I put that slide up, I will get more than 90% agreement that what that slide is saying is true. And that slide is showing, going right back to 1949, index of prices paid, that is fundamentally the operating costs of a station or a farm. So that's the orangey red line, and it's going up rapidly. And then prices received is the income. So the green line is the income for the farm, the red orangey line is the costs of running the farm, going right back. And if you look at that, it looks like that's telling you that costs are rising exponentially, prices aren't rising fast enough to meet them, and we're all doomed. It's a hand slide. Unfortunately, it's a complete myth. It's untrue. Because when you start to understand finance, you'll understand that when you look at long-term data like these, you must always take inflation out. You must always look at these numbers in today's dollar terms. So if you go down to the bottom right-hand corner, you'll see there's a gap there. That should be 2014 there. So when you take inflation out and look at this in today's dollar terms for 2014, 2015, it looks entirely different, as you'll see in the next slide, Penny. Right, inflation's taken out. This is a completely different view. There is no evidence, none whatsoever, that the operating costs of any farm business anywhere in Australia, pastoral or non-pastoral, has gone up faster than inflation. It's flat. Costs are not the issue. The issue is that the prices that we receive for what we produce are falling. This is all Australian agriculture here. That's the 1952 wool boom when people were mustering sheep in Rolls Royces. That's the beef boom there, and there's been a few wheat booms here and there. But all the commodity prices that we produce in Australian farms in today's dollar terms are falling over time. So that produces a totally different mindset. If you believe the first slide, your strategy will be, right, lock the checkbook in the drawer, stop spending. It's all about cost control. We will starve our business through this with cost control. Wrong. I'm sorry. You can't do it. It will fail. The answer is in this second slide, and the answer is if costs are flat and prices are falling, the only answer is improved productivity. We have to get more kilos of what we produce going out the gate at the same or a lower cost base. That's the answer. Productivity. It's if you're in beef, it's more kilos of beef going out the gate for the same or lower costs. If it's wool, it's the same. If it's lamb, it's the same. If it's wheat, I don't care what you do, it's the same answer, better productivity. And the good news is that there's enough scope in that productivity area to keep us going for another generation at least. There's so much potential there to improve productivity that the hands of this world will be proven wrong. Well, they will for another generation, and I don't know about you guys, but I'm not going to be here after that, so that's someone else's problem. But at least in my term, and for many of you out there, it's going to be all good news, because the productivity prospects are, at this stage, huge. Next, thanks, Penny. And this is probably the most difficult and controversial slide in this webinar. A couple of years ago, a colleague of mine were asked to produce the Northern Beef Report for MLA, and we had to provide a situation analysis on what was going on, and to do that we had to apply some criteria for economic or financial sustainability. And the principles behind this go into a lot of literature and science and so on, and go into sustainability theory. And sustainability theory says if you are going to talk about sustainability, you must define what it means. And so before we wrote that report, we set out the following list of criteria that can be applied to any farm business anywhere in Australia. It doesn't matter. It doesn't matter whether it's southern rangelands, northern rangelands, high rainfall zone, or whatever. These criteria are true, and they have been examined by all sorts of economists and accountants and people, and so far in the last 2 years since we published this, no one has come up to prove it wrong. They are confronting, and you will say they're impossible, and they will probably get you upset, but nevertheless, there they are, and they're the starting point for any serious discussion on this. So the first point, Penny, please. You've got to generate a return that meets or exceeds your cost of capital. I say, what's your cost of capital? Well, it's the cost of debt. It's whatever your interest rate plus fees and charges are. That may be, 5, 6, 7, 8%, whatever it is. That's your cost of capital. Your total business return must exceed that. Your total business return is made up of your return on assets, your operating return, that's what you do every day. So at the end of the year, your total profit before tax divided by your total assets will give you your business return. That's one part of it. The second part of it is your capital return. That is, how much have your assets appreciated or depreciated in that year? You add the two together, that gives you your total business return. If this is not the case, if you can't achieve this one, then it's just mathematical certainty that your equity will erode over time. This is a make or break one, and it's one we pay a lot of attention to. So the capital return, capital appreciation, is a windfall gain that you can't do much about. It's the operating return, the one that you can do a lot about, that we put most of our focus on. So that's the first one, and it's the hardest one to achieve, perhaps, but it's make or break. The second one, Penny. You've got to fund all of your operating expenses, what it costs to run the show, and your operational capex. So capital expenditure is, operational capital expenditure is, let's say you have a quad bike that's worn out and you've got to replace it. That's capex, and that's operational capex. If you go out and put in a new water somewhere, that's development capex, and that's a different story. So you've got to fund all your operating expenses and operational capex through internally generated working capital. Your business has got to be producing enough money to fund ongoing expenses and operational capex. If it's not, then there's a warning bell going off. And it's so simple to determine whether that's happening or not. If you are operating on an overdraft, which a lot of businesses do, if you're operating on an overdraft, that overdraft has got to go into the black once, preferably twice a year. It's there to allow you to fund seasonal shortfalls in sales. It's not there to fund the operation of the business. So if that overdraft is constantly in the red and it never gets into the black, it's not the business that's funding those things, it's the bank. And it's a precarious position, because if you ever get into trouble with the bank and they start putting pressure on you, and that pressure involves withholding funds for operating expenses, then you're in serious trouble. So the business has to at least do that. The next point. Fasten your seatbelts, folks. This is where you'll be wanting to reach for the shotgun and shoot me if you can. Remunerate its owners adequately, at least to the standard of the average wage earner. What's the average weekly wage for full-time male employment in Australia right now? $75,000. This is the average worker out there, the average unskilled worker out there in Australia pulls in 75 grand pre-tax. The average female, 65 grand pre-tax. Add them together, 140,000. So, husband and wife team working on a station in the southern rangelands, the business should be able to pay the husband and wife team at least $140,000 cash, PAYE. If it can't, the reality is the husband and wife team are making a lifestyle decision to prop up the business. Perhaps they're only drawing 50, 60 or 70,000 and foregoing what they should be paid to manage, 6, 7, 8, 10 or more $1 million worth of assets, foregoing that in order to prop the business up. As well as that, there are the non-cash benefits of living on the station, living on site, rent-free house, meat, car, phone, fuel, all of that. For a family of 4, mum and dad and 2 kids, that's worth normally about $30,000. So you add that into the 140 we talked about earlier, there's $170,000. And if I said to you, your business should be capable of providing the $30,000 worth of non-cash benefits, no argument, but in addition to that, it should be able to pay you at least $140,000 pre-tax. I think a few eyebrows will be raised, but surely mum and dad managing a station of those asset values and the complexity that goes with the management, surely that mum and dad is worth more than the average wage earner. If the business can't do that, it is not financially sustainable. Next point, Penny, please. This will probably be a subject for a follow-up webinar that Penny can provide details of later. I've mentioned it already. Debt is, you've got to treat the thing like a brown snake. It can kill you if you're not careful. And here we're talking about repayment. And I won't go into any more detail here and now other than to say, if you cannot foresee paying off any loan that you take out within 10 years, you should not take it out at all, because the cost of leaving it there beyond 10 years, the cost of debt becomes prohibitive and will seriously impair business performance. I have to leave it at that because time is a constraint. Next point, please. Safe level of equity in the long term, 85%. If you drop too far below that for too long in the average pastoral business, in my experience from all the data I've seen over the years, if you drop below 85% in the pastoral zone, 85% equity, interest is going to consume too much of the working capital, and you won't have the funds left over to do some of the other things that are coming up in this list of bullet points. That again is the subject for another webinar, and I'm not suggesting that it has to be at 85 or above all the time. You may make a major acquisition and it may drop below that temporarily, but it's got to get it back up to at least that for the business to be safe in the long term. Next, please, Penny. Oh, business succession. It will destroy businesses and it will destroy families if you don't manage it properly. And the management has to start early on. it's an unfortunate fact of family farm life that succession is there. And like it or not, it's expensive. It's impossible to treat the kids equitably. You know, if you've got a $10 million business and you leave that to the son, if you're going to be equitable, you've got to give a $10 million check to the daughter. And, you know, it never happens. So it comes down to treating them fairly, and then what does fair mean so that the whole family stays intact? It's an issue that goes way beyond today, and it's probably a webinar in itself. But all I can say is the provisioning for it must start early on in the business if the whole thing is to work out well. And so, you know, if I'm sorry, guys, but Dad is public enemy number one in this most of the time. It's too threatening for him. Rural males are not very good at thinking beyond their term on the place and thinking about life beyond retirement. And so the whole business of succession is very threatening to them. The kids want to know what's going on. Mum wants to hold the whole family together. Dad's often the roadblock, and it gets delayed and delayed and delayed. And then one day Dad wakes up, he's 55 and 56, and he says, oh, I want to be out of here in 10 years' time, and I haven't done any planning for this. Well, folks, it's too late then. You know, if there's only 10 years to go, you haven't got enough time to make all this happen. So, subject for another day, perhaps. Next, please, Penny. Along with succession comes independent retirement, and it's important. So, the worst thing that can happen is if Mum and Dad move out of the main house down into the cottage or donga, and next generation move out of the donga up into the main house. Mum and Dad still hang around. Mum goes into town, does whatever, or pursues her interests. Dad gets up every morning, gets on his bike, chucks the dog on the back, goes out with a pair of pliers and strains wires all day. That is not independent retirement, because they will still be drawing from the farm business, probably. And there's all the problems, social and family problems that come with that transition from the two generations, and what the dreaded daughter-in-law may be doing to the kitchen in the main house. The dreaded daughter-in-law has her rights and should be respected. If she wants a new kitchen, she should have one. And all these family issues surface with all of this. So providing for independent retirement for the existing owners is important. And here's the bad news. If you want to be independently retired, and you want to be able to preserve your capital in your retirement fund to be able to treat the kids fairly. So the son might get the place, but the daughter may end up with the estate when you pass on, and you want to preserve your retirement fund in the estate to make it fairer for her. Independent retirement means accumulating 1.6 million before retirement. That's about what you'll need for that to happen. If you want to run your retirement funds down, and so there's nothing left in your estate in that area, then 900,000 will allow you to retire independently and have a comfortable middle-class existence throughout your retirement. So that independent retirement issue goes hand in hand with succession. And finally, Penny, the last slide. Folks, this is important, really important. You cannot hope to be financially sustainable in the long term if you are eroding environmental capital to do so. In other words, if your place is being flogged to keep you there, then that's a no-no. And and really the two go hand in hand. You've got to treat environmental sustainability and financial sustainability the same. Penny, I think I've probably nearly used all my time on this. Do you think?
That's all right. Yeah, no, thank you for that. We appreciate that. I'm just looking at time, and I'm thinking I might just ask one question of you in this point. So, in your opinion, is there any cases where pastoralists can't recover from their current debt situation, and is selling the property and starting again the solution?
Oh no. Debt recovery is the preferred option if the station is a good one and has the potential to be a good business. Yes, I would have to say that it gets increasingly difficult when equity drops below about 55%, perhaps 50%. It's really hard, and it'll be struggle street for a long time, and the focus has to be on profit and generating enough profit to start serious debt repayment. But no, it's not a forlorn hope. And if you do sell, you'll be selling on the back foot probably, and you'll be left with less equity to go into another place. So I would always try to keep the current place going, and I would have 100% on focus on increasing profit so that I could get my equity back up as quickly as possible.
Thank you for that, Phil. I'll just move on. So now we're going to introduce Andrew and Megan Miller. So Andrew's online with us today. He's from Braidwood Station in Junda. I'll just get him, let him speak. Hi Andrew, how are you going?
I'm well, thanks Penny. How are you?
Good, thank you. You've been enjoying the webinar so far?
Yeah, no, it's been real good.
Good. I'll pass you over to Phil now, and Phil's got a couple of questions to ask you.
Andrew, are you okay to answer some questions?
Yeah, yep, fire away, Phil.
Righto. So looking back, how well prepared were you to run the business and the operational aspects of your first grazing business?
Well, looking back, Phil, in hindsight, we weren't very well prepared at all. We went into our first grazing business with a few handy dogs and a bit of stock sense, and thought it'd be a walk in the park. It didn't take long to realise that we had no business sense and we needed some.
So what were the things that happened that made you realise that your business skills were maybe needed a bit more work?
I suppose one of the first things that sort of bobbed up, it became clear that we weren't, after not very long, it became clear that we weren't overly successful. And we're the sort of people that want to do well in whatever situation we find ourselves in. So running a grazing business was no different. We wanted to do well, and we didn't have the working capital and those sort of things that you just spoke about to do what we wanted to do and to sustain our business in the short term, let alone long term. So that was sort of the first thing. Another sort of thing that, other things along the way, I did an AWI breeding leadership course, and that was sort of fortunate to be involved in that. But that was one thing that really opened our eyes to the need to see our station and our operation as a business, and to treat it like a business, and to see ourselves as business people and business owners and business managers. And so just that seeing ourselves as business operators was sort of, or the lack of that was probably the main thing that made us realise we need a bit more work.
So when you started to focus on the business a bit more, did it change anything that you did in the paddock, how you do it?
Yeah, it did. We sort of, we went from sort of running around a bit. I was sort of Megan was inside and I was outside and I was running around, making sure all the wires were tight and the fences and the vehicles were serviced on time, and completely ignoring the fact that we had possibly the wrong enterprise mix and we were selling stock at the completely wrong time, and our genetics were heading in the completely wrong direction. And so when we started focusing more on the profit drivers of our business, we spent more time inside and less time outside, and that came with sacrifices. But it meant that, in time we had a chance of getting back and sorting out things that needed to be done. Another major difference that we noticed was employing more labour. When we got busy, stock work or whatever, we put on more labour to get in and get it done and get it out of the road properly and efficiently, so we could spend more time working on our business as opposed to poking along on our own, trying to save, a few bob here and there with a bit of labour. And the job that could take a week with 2 or 3 men, we were dragging out to a month and sacrificing a lot of time focusing on our business.
So it sounds like you and Megan have got a pretty good partnership going, where both of you are across the whole business, but you've each got your own areas of responsibility.
Yeah. Originally, we sort of, we kept pretty separate, and as far as we kept our roles very separate. That was, it didn't take long to sort of realise that wasn't sort of the best idea. I sort of did everything outside, and Megan, apart from having a young baby and teaching kids through distance ed and that sort of thing, did the bookwork and that inside. And we sort of, if the accountant rang and Megan was away and I had to speak to the accountant, I had no idea what to say. And if someone rang in regards to stock or a date for me, to go away and do some contract work or whatever, we had, Megan had no idea. So along the way, we sort of tidied that up. And although we still are responsible for different areas, we both have a good understanding of each other's side of the business. I can speak to the accountant quite fluently nowadays, and Megan knows the husbandry side of things, and has got a pretty good knowledge of my side of the affairs.
Yeah, okay. So given all that, and where you've come from to where you are now, what would be your advice to rangeland business owners who weren't that confident about their business skills being up to speed?
Yeah, Phil, I'll probably just refer back to that previous point in working together. It made a big difference to us, and in turning our business around from what it was to got it heading in the right direction. It really made a difference when we started working together. Another thing would be to prioritise things that need to be done and focus on what matters. If there's a pipe leaking, for example, for another day, it's probably not going to kill you or send you broke. Whereas you might be able to spend a little bit more time working out, the best place to sell or the right genetics, getting the right genetics into your herd or flock or that sort of thing. So spending time on what matters is another one. And surrounding yourself with the right sort of people, Phil. I sort of believe in that. If you want to head in a particular direction, surround yourself with people that are going that way and speak that way and are positive about the industry and that sort of thing. And also, I've got a couple more quick points. It's sort of, we originally went into things and we had ideas of what we wanted and what we wanted our herd to look like and what we wanted out of our sheep and what we wanted out of our property. And when people said, oh yeah, why? Well, we had no idea. And when we started making decisions around the profit drivers of our business, we started, we had a good explanation for all the decisions we made. I think that's important to be able to know what you're doing and why you're doing it, and don't be afraid to do something a bit different if it stacks up. And lastly, I'd probably say it's quite easy to rush into things and go out and buy bulls because you need them in a hurry, or to make any sort of decisions like that. Decisions about enterprise mix or especially something that will be facing a lot of people in the next few months or 12 months or so is drought recovery, and it's a lot easier and a lot cheaper to do scenarios and work scenarios out in the office as opposed to rushing out and seeing a mob of ewes on Auctions Plus and slipping out and buying them without working out the scenarios and what really is going to fall out of the what profit's going to fall out of the bottom of that decision. So making your mistakes in the office and making sure you're making the right decision before you go out and do anything is another sort of key thing that helped us along the way.
Spot on. Thank you, Andrew, and Megan in the background. Thank you. That's excellent. Penny?
Fantastic. Thank you. I might just move on because of the time. We won't have any questions from that session. So I'd really like to thank both Andrew and Phil for their input for today. It's been great, and it's been a great way to launch our Pastoral Profit program and hopefully give you some ideas and a taster of what kind of activities and things that Pastoral Profit want to focus on and provide for pastoralists. So thanks, Andrew, and thanks, Phil.
Pleasure.
Thank you. So what I want to just finish on is Phil mentioned it. We're going to go into a second webinar, so save the date for Tuesday the 14th of July. What we're looking for and what we're looking to do is to answer some more of those questions that have been coming through today, maybe focus on a few of the key points and give you some of the knowledge that to help you along the journey towards economically sustainable business. So where you start and going into further detail on that. So feel free to contact me if you have any specific questions. There's been a lot today that we won't be able to get to, but I'll keep them in mind. We are recording this webinar today. It's being recorded as we speak, so that will be being made available via the website, and I'll also send you all a link, so to everyone that's registered will receive a link. Also, finally, I'd really appreciate it if you could quickly complete a short survey that finishes when you finish this webinar. It'll pop up. It'll give us some feedback on how we went and also help us improve for next time. And also give us some, if you want to provide some ideas on what guidance on what sort of on-ground local activities you might be interested in, and maybe today's webinar has given you some ideas on, what could really help your business. So I also will encourage you to get in touch with the regional coordinators. Their details are on the screen now. They'll be the ones that will be able to help you in your own area, and we're really excited to be able to provide you with Pastoral Profit and what we're about, and also some key learnings from Phil today. So I really appreciate you all joining us, and thanks again to Phil and Andrew, and to Meat and Livestock Australia and Australian Wool Innovation. And I will, hopefully hear from you soon, and I hope you have a nice day. Thanks for joining us.